let's just start with some of the price action we got out of European fixed income yesterday. OAT is 8 basis points wider after that snap election announcement. Was the reaction warranted?
Yeah, morning, Joumanna. I mean, markets don't necessarily like, shock, surprise announcements, and obviously don't like uncertainty. And we've been here before with French elections, and it's quite normal for us to expect noise and volatility in French assets when there is still the sort of presence of a threat from the extreme right on the political spectrum. So understandable. Whether it's warranted, I guess, in the end, I still think consensus view is that it's very difficult for Marine Le Pen's party to win in the second round. I would share that view. And so ultimately, this is probably a sort of fade. But I think just given the starting point was relatively tight spreads across, credit in general and sovereigns in particular, it doesn't surprise me that we've seen a bit of widening off the back of the weekend news.
James, if I fast forward the next couple of months, I mean, this isn't all about political premium. There's also concern about the fiscal trajectory of France as well. They got downgraded not so long ago. Should investors start feeling worried again about this possibility of fragmentation risks?
Crumbs. Yeah, we're probably away from genuinely considering fragmentation risk, but I mean, yes, ultimately, we should be concerned that the fiscal trajectory in a lot of countries just looks incredibly unsustainable. But whereas in most places that is a policy entirely within the ken, and fiscal and monetary authorities are ultimately the same. Obviously, in the Eurozone, you don't have that situation, and fiscal and monetary are separate, and therefore you have this credit risk, which is inherent in the system. What the right compensation for that credit risk is, obviously, is very subjective and does ebb and flow over time. But France in particular, France and Italy, you look at their debt loads, you look certainly at the government as a percentage of GDP in France, and just the systematic incapability of politicians to rein in fiscal spending, to actually engage in the sort of reforms which are going to allow deficits and debt come down over time. The Maastricht criteria are so far in the rearview mirror now, it's unbelievable. And obviously in the pandemic, the fiscal compact and the various fiscal frameworks were completely thrown out the window. At some stage, all of that will come back on the agenda. It's probably not just yet.
Yeah. Well, you talk about fiscal sustainability concerns. The U.S. have a budget deficit of 6.3%, debt to GDP of 124%. To what extent are you concerned about the fiscal trajectory of the U.S., given what you just articulated about these European nations?
Yeah, again, really, really am. Long ago we talked to feed the beast and starve the beast between Democrats and Republicans, and for quite some time now that's just been feed the beast, feed the beast. One wants to raise spending, one wants to cut taxes. Nobody wants to rein in the deficit at all. And to have over 6% deficit at the end of the cycle really is a concerning place to start. And obviously rates have gone up, and so the interest bill, as everybody seems to know now, is gigantic, is basically bigger than defence spending within the budget. All of that is incredibly concerning, and I don't see any political will significantly within Congress or within the White House, whoever is the incumbent come January, to do anything about that. And so long term, it really does appear to be a concerning situation, and it's likely that the Fed is part of the solution.
Yeah. All right, let me ask you about the Fed. What are you expecting for the dots? Do you see the median moving down to 2? And if that is the case, would it be a dovish surprise?
Yeah, I mean, I definitely think the dots is going to be a big focus for markets, and just given the data that we've seen, given some of the rhetoric we've had from Fed speakers, it wouldn't surprise me at all if we're reducing the number of cuts over the horizon. So maybe 24, maybe 25, maybe both. It is very difficult to say. Ultimately, I don't think the dots are a guide for policy. That's not what they're intended to be. Inherently, the macro forecasts within each individual's dots are not identical, and so you cannot compare them like for like. But of course, the market does like to focus on them. Given the rally that we'd seen sort of a month ago had taken US rates down to sort of local low, I think there is room for rates to move higher in a sort of shock fashion if we do see a more significant move higher in the dots. So I think that's the risk. I think the base case is there's some move higher. How big it is would dictate the extent to which the market is shocked and surprised. I think the dollar is going to benefit significantly if that's the case.